the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market fared, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started or some key movements on the SGX. Singapore shares inched higher today to track a positive session on Wall Street. So if we look at the STI at about 2:31 p.m., it was up 0.17% at 3,882 points, with a value turnover of 578 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI closed 0.16% in the green at 3,882 points. In terms of value turnover, we are looking at 1.03 billion Sing dollars. The gainers outnumbered losers 263 versus 195. Top advances for today we've got for USGX, HPL and ASUS, and top decliners we have here Ventureco, Shangri-La Hong Kong Dollars and Semco Industries. Now, in terms of companies to watch for today, we've got for you DFI Retail Group, because the group's underlying profit for Q1 2025 fell 18% on a yearly basis due to the divestment of Yonghui Superstores last year. Now, elsewhere from China, Central Bank cutting two key interest rates to spur the domestic economy, to the Reserve Bank of Australia slashing its main cash rate by 25 basis points. We've got more economic and international headlines in focus. And also on deck, a look into Chinese battery giant CATL's Hong Kong trading debut. Now, let's break down the developments with Kelvin Wong, Senior Analyst at Oanda, and he joins me on the line. Kelvin, welcome.
Thank you, Tintin, for inviting me back to your show again.
Great to have you. And Kelvin, let's start with the Singapore stock market as usual. How did the STI fare today, and any surprises when it comes down to the biggest movers and the sectors that they lie in?
Actually, there's no much major big surprises to me. What we could see now, the STI is now seems to us that it's in kind of a profit-taking or a mini consolidation phase for 5 consecutive sessions, holding below that psychological 3,900 level. And it seems to me that the Singapore market is waiting for a brand fresh new catalyst to either spur the STI higher or lower after that significant pop-up on the 13th of May, which is the conclusion of that US-China 90-day pause for a lower tariff rate between two of them, the two superpowers here.
Okay. And Kelvin, let's zoom in on the companies to watch. We have here DFI Retail Group, because the group's underlying profit for Q1 2025, that fell 18% compared with a year ago period due to the divestment of Yonghui Superstores last year. Now, if we exclude the divestment, the underlying profit of the group rose 28% for Q1 compared with a year ago. I know you don't comment on individual firms, but generally speaking, how far are the numbers in line with other industry peers given the global headwinds weighing on consumption in Asia?
I think what I see the trend, it seems to be moving in the broader trend of this kind of a rather cautious consumer spending that is being seen in Asia and even in the rest of the world as well. So unless we got much more clarity in terms of from the health of the major developed nations, especially the U.S. economy, primarily driven by the uncertainty surrounding the current White House, current administration of implementation, a rather haphazard way of trade tariffs policy. There could be a risk that we may start to see persistent kind of lackluster consumer spending that may stretch out into the second half of this year.
Now, talk about managing risks across the region, Kelvin. Today we saw how the Australia's central bank cut its main cash rate by 25 basis points to a 2-year low of 3.85%, citing this darker global outlook and, of course, cooling inflation at home. I understand markets, they were expecting an easing given the slowdown in domestic inflation in Australia. But really, how did investors react with their money if we look at movements in Australian equities and currencies?
Maybe let's look at from the Australia equity perspective, all right? Yeah. Because we know that, number one, the primary driver for equities tends to be forward-looking and also driven by liquidity itself. So what I could see over here is that the Australian Central Bank, if you look at the last year of monetary policy stance, they have been rather more on the cautious side, and perhaps I would say more on the hawkish side of the thing versus the other central banks. So in fact, they only kickstart their first interest rate cut at the start of this year, whereas you compare to other developed nation central banks like ECB that has really kickstarted its interest rate cut cycle a year earlier, and that's also including the Fed itself. So what we see over here is that today's ex-post RBA monetary policy decision meeting, which is the press conference held by the RBA Governor Bullock, she actually sounded much more dovish this time now, stating that in fact this particular meeting that's concluded today, there's actually some board members who are contemplating to have a 50 basis point cut instead of a 25 basis point cut. So at the end, they decided to go for 25 basis point cut. So that actually signaled to us that the RBA officials, several of them have started to turn rather cautious of a slower economic growth slowdown that may hit in Australia in the second half of this year, primarily due to higher trade tariffs on Australia key trading partners, especially on China. So that itself actually spurred market participants in anticipation for a much more dovish RBA in the second half of this year. That means potentially there could be an increase in liquidity in Australia economy that actually drove the Australia, we call it the benchmark index, which is the ASX 200, up by 0.6%. And in fact, it's one of the top performers today, other than the Hang Seng Index in the Asia Pacific stock market.
Don't mind me asking this, Kelvin. How far is what you mentioned about the outlook priced in currency markets for the Australian dollar?
Yeah. So back to the FX market. So if you look at FX market, we need to look at two equations. Okay. I mean, it's always relative. So we know that today the Aussie dollar underperformed because of a sudden change in guidance from RBA. Previously, they were much more cautiously dovish. So right now, they seems to be much more dovish instead of after that mention of RBA governor, as per highlighted earlier. So the Aussie dollar actually is one of the worst performer among the major currency against the US dollar. They're now down by negative 0.6%, almost coming close to the ex-post RBA monetary policy decision today, which is an intraday low of 0.648, now trading at 0.6408, pardon me, now trading at 0.6419. But on the other hand, if you look at the US dollar index, which is a measurement of broad dollar strength or weakness, in fact, the dollar index is actually down by this 0.12%. So overall, in the FX landscape right now, you see a general sentiment of a broad-based dollar weakness that is still intact. So going forward, I do expect that the dovish stance from RBA today might be offset by this broad-based dollar weakness. So perhaps in the near term, the Aussie dollar may to actually trade in a rather sideways range rather than the outright start of a medium-term downtrend.
Okay. Now, Kelvin, Australia is not the only country lowering rates. If we look at China, the PBOC cut 2 key interest rates as officials battle to kickstart the economy. So the one-year loan prime rate, which is the benchmark for the most advantageous rates lenders can offer to businesses and households, that was brought down to 3% from 3.1%. If we look at the 5-year loan prime rate, which is the benchmark for mortgage loans, that was cut to 3.5% from 3.6%. Both rates are at record lows. So what are the implications of the move on the Chinese yuan?
Okay, so if you look at the Chinese yuan as per se over here, is that it has been holding on rather stable against the dollar, right? So they're holding the dollar CNH, which is the dollar against the Chinese yuan offshore rate, has been around the 7.2 level. It didn't break below 7.2. But what we could see over here is that apparently the yuan against other trading partners' currency, especially against the euro. Why is it against the euro? Because if you look at the current context of this ongoing trade tension hostility between US and the rest of the world, especially China, European markets will be a greater share of exports for China exports going forward. And in fact, in the last 2-3 years, the export share, China export share in the European market has actually risen at a faster pace as compared to US. So if you look at the euro offshore CNH, they've actually been strengthening. That means we're talking about yuan weakening against the euro dollar. So say that over here is that yes, we may start to see a kind of stabilization between the CNH against the US dollar. But going forward, I do expect the Chinese yuan, especially with the potential further lowering of future interest rate cuts by PBOC, that could actually see the yuan weaken, but not against the dollar, but more against the other trading partners' currency, like against the euro.
And my second part of the question, Kelvin, if I may, is how far can the move then bolster the Chinese economy given the wider tariff wars?
Yes, I think what we've got to see over here is that it's definitely kind of a brave new world, I would say, in the financial situation, financial markets right now, is that, number one, will there be more trade pacts being signed by China with much more friendlier nations like the European or Southeast Asia to diversify its market away from US? And also, we also need to see, will there be a possibility of shift of capital allocation from US into the rest of the world, especially in Asia, which is i.e. China, Hong Kong, which is part of that. And do not forget, since COVID, the US stock market has been in a very strong mode, and in fact, market participants has been pouring tremendous amount into US capital markets for risk assets, as per se, which is the US stock market, allowing the benchmark US stock indices to be that supreme outperformer against the rest of the world since COVID. And right now, given that situation has started to change due to the current administration policy, would that be further strengthening of this shift away from U.S. accessionism play back towards the rest of the world? So if you look at the rest of the world stock market, as per se, they're actually outperforming the major US stock indices based on the year-to-date basis.
Okay. Now, if you're just tuning in, we're now in conversation with Kelvin Wong, Senior Analyst at Oanda. Well, in corporate news, Kelvin, Contemporary Amperex Technology Company Limited, also known as CATL, it rose in its Hong Kong trading debut after the Chinese battery giant wrapped up the world's biggest listing this year by raising 35.7 billion Hong Kong dollars or 5.9 billion Sing dollars. Now, that is despite it being blacklisted by the Pentagon and grinding through the geopolitical storms we talked about. So if you look at shares of CATL that opened up 13% from their listing price, how far could CATL's listing encourage other firms to seek an IPO in Hong Kong, and what is the outlook for the Hong Kong bourse in the near term?
So if you look at the current situation right now, especially taking into context of this ongoing U.S. trade tariffs narrative that is still playing out, so I do believe that companies will want to actually hedge their bets. Yes, we know that the U.S. stock market is the world's most liquid in terms of breadth and liquidity, but given the current U.S. White House administration, they are advocating, it seems to be a magnetic pull away from the U.S. capital markets heading into the rest of the world. So if you look at the success, we call it a performance of today's IPO, as mentioned earlier, in the Hong Kong stock market by these leading EV players, I do reckon that the Hong Kong bourse may start to see a greater pipeline of IPO heading into it. And that also explained to us, number one, the anticipation of much more IPO listing, and that actually create this positive feedback loop into the Hang Seng stock indices. And in fact, today the Hang Seng benchmark stock indices is one of the star performer for today, where the HSI is up 1.5%. The H shares, where primary consists of China mainland company, is up by 1.5% today.
Okay. Yeah, and finally, Kelvin, let's end off with more corporate news. Apple supplier Foxconn said in a London Stock Exchange filing that it will invest 1.5 billion rupees in its India unit as the iPhone maker shifts more manufacturing out of China. How far are we seeing that shifting of supply chains play out across the industry, and how would you read into the move then?
What I could see over here is definitely due to the pressure of the U.S. White House administration. So definitely for sure, we will start to see this major, we call it readjustment or realignment of supply chain away from China to countries that are actually deemed much more favorable to U.S. But in fact, it seems to us that U.S., they are adopting a much more aggressive stance that they want factory to be built in U.S. rather in countries that are deemed friendly to U.S. That was during the Biden administration. So I believe that late last week, U.S. President Trump has friendly call up with the CEO of Apple, urging him to actually shift Apple's, we call it, right now, we call it the increase of Indian production back onshore to U.S. instead. So, yes, we're going to see this more pressure from the U.S. administration, urging MNCs to actually rebuild their plants into homeland, back to homeland in the U.S. But the big concern for us right now as traders or market participants, that would that lead to a rise in inflation in U.S. because bear in mind that once these products shift into U.S., cost of production will definitely go up due to a much more stronger labor union in the U.S. And that could also potentially start to see potential downside pressure on the margins of these U.S. MNCs.
I see lots to watch as usual. Thanks so much for the insights, Kelvin. That was Kelvin Wong, Senior Analyst at Oanda. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.